It wouldn't surprise me to see silver take 2 years to break out relative to gold. It also wouldn't surprise me to see it happen this fall. All I know is that silver doesn't move until a generalist investor comes to the precious metal space. The generalist investor comes to this precious metal space because of momentum established by gold. When that happens, I don't even know why. I suspect it's because of the lower unit cost to buy silver. But when it happens, it's truly, truly, truly dramatic. I've seen it happen 3 times before in my life. And Charlotte, it's been pleasant. If I have to wait 2 years for that circumstance, I've been on Earth for 72 years. I'm okay with 2 years. But those moves are really, really, really dramatic. And silver has substantially lagged gold in terms of this move, as it always does in a bull market.
The dynamics currently unfolding in the precious metals market, particularly in silver, are closely mirroring historical trends seen in past commodity bull cycles. Silver, long recognized for its dual role as both an industrial and monetary asset, has a history of trailing gold in the early stages of bullish momentum. Rick Rule, founder of Rule Investment Media and a veteran in the natural resource sector, notes that gold typically draws institutional attention first, benefiting from factors like economic uncertainty, inflationary pressures, and accommodative central bank policies. Only after gold establishes a strong price trend and captures wider media and public attention does silver begin to follow. When it does, the move is often sudden and amplified, driven by a surge of retail participation and speculative demand. This classic pattern appears to be unfolding again. Silver has recently broken through major resistance thresholds, climbing above $37 and $38 per ounce in London trading, levels last seen in 2011. This recent price acceleration followed heightened geopolitical risk and the announcement of new U.S. trade tariffs on key industrial metals such as copper, prompting some investors to pivot into silver as a strategic hedge. London's midday pricing benchmark reached $37.50 per ounce, a 1.7% increase from the previous week, underscoring renewed appetite for physical silver. Meanwhile, holdings in silver exchange-traded funds, particularly large vehicles like iShares SLV, have posted continuous weekly inflows for over 2 months, indicating a growing conviction among investors that silver is poised for further gains and possibly a longer-term structural shift in demand. Rick Rule emphasizes that silver bull markets, while infrequent, are known for their speed and intensity. He recalls 3 major silver rallies in his professional lifetime, each of which delivered outsized gains in a relatively compressed time frame. One of the clearest signs of tightening fundamentals is the sharp rise in London silver lease rates, which have increased from 1.7% to more than 5.3% annually, reflecting higher demand for borrowing and declining physical availability. While no one can predict the exact timing of the next major silver breakout, whether it occurs within months or a few years, Rule firmly believes that the fundamental groundwork has already been laid. Between macroeconomic drivers, tightening supply, and increased investor attention, both silver and gold appear well-positioned for a significant revaluation as market forces converge. Now, we present the clips from Rick's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When people ask me when the gold price is going to move, as you know, I say the year 2000. It's up 9% compounded annually for 25 years. Pretty good record. And they like more dramatic moves, which they've begun to enjoy. My thesis is very simple. My thesis is that the gold price moves relative to people's faith or lack of faith in the maintenance of their purchasing power in fiat currencies, primarily the US dollar. I believe that as a consequence of our debt, our deficits, and the unsustainability of our entitlement program, arithmetic unsustainability, that the US dollar will lose 75% of its purchasing power over 10 years, just like the decade of the 70s. I suspect that the gold price will more or less mirror the deterioration in the purchasing power of the US dollar. Arithmetically, if you believe that there's a causal relationship, if the US dollar declined by 75%, it suggests that the gold price could move up 4-fold. Will it be 3-fold? Maybe. Will it be 5-fold? Maybe. What isn't in dispute to me is that absent a real sovereign default, The U.S. dollar has to lose 75% of its purchasing power to make the on and off balance sheet obligations of the U.S. government serviceable. I suspect that the deterioration of the dollar relative to other currencies will begin to subside. I think that people have been selling the dollar reflexively because they don't like our president. I don't like our president either, but I haven't been selling my dollars relative to other currencies. I think that in a relative sense, which is to say relative to other currencies, the U.S. dollar will do okay over 10 years. I think U.S. hegemony will decline. Doug Casey described the dollar once relative to other currencies as the prettiest mare at the slaughterhouse. And so I would suspect over 10 years, relative to the Canadian dollar, relative to the euro, relative to the renminbi, the dollar will do okay. But in an absolute sense, you buy with $1,000 today, it'll cost you $4,000 10 years from now. In an absolute sense, it'll do poorly. In an absolute sense, your audience is going to hate me for this, but the Canadian dollar will do a little worse. It wouldn't surprise me to see silver take 2 years to break out relative to gold. It also wouldn't surprise me to see it happen this fall. All I know is that silver doesn't move until a generalist investor comes to the precious metal space. The generalist investor comes to this precious metal space because of momentum established by gold. When that happens, I don't even know why. I suspect it's because of the lower unit cost to buy silver. But when it happens, it's truly, truly, truly dramatic. I've seen it happen 3 times before in my life. And Charlotte, it's been pleasant. If I have to wait 2 years for that circumstance, I've been on Earth for 72 years. I'm okay with 2 years. But those moves are really, really, really dramatic. And silver has substantially lagged gold in terms of this move, as it always does in a bull market. For some people that have trauma holding a position over a long weekend, they should do something else, buy bonds or something, If you're a speculator, and if you're a speculator who can tolerate perturbations, volatility, if you can tolerate for a time boredom, the setup in silver from a speculative point of view, using history as a guide, is spectacular. The nominal highs for silver are $50, but that isn't the real high because the purchasing power of the dollar is deteriorated. If you did constant dollars, the previous high is probably $80 or $85 an ounce. And I would expect personally that silver handily takes out those prior all-time highs. I bought a little bit of the Sprott Physical Platinum and Palladium Trust simply because those metals were priced below the total cost of production. And I bought a reasonable amount of a small exploration company called Bravo, which has made what I consider to be a fairly major platinum and palladium discovery in Brazil, one that looks much more attractive at today's prices than it did a year ago. When I looked at investment options to express my preference for platinum and palladium, life got very difficult. Sibanye-Stillwater is the obvious choice, but there are political impediments to Sibanye-Stillwater in South Africa and the ongoing economic reconciliation in South Africa. The best platinum and palladium company in the world by a country mile is Nornickel, the old Norilsk in Russia. But for various reasons, that's a rough place for an American to invest. And so I haven't been able to express that preference, although I do own some suspended shares in that company from the old days. So in terms of being able to express the work I did, I was able to take a reasonable position in the Sprott Physical Platinum and Palladium Trust in the physical metal. And I was able to buy an immodest, which is to say a generous position in Bravo Mining.
Many analysts are increasingly concerned about the long-term outlook for the U.S. dollar, warning that it could lose a significant portion of its purchasing power over the next decade. This anticipated decline would mirror previous episodes of severe inflation in American history. Since early 2024, the dollar has been gradually weakening against major global currencies, reflecting growing doubts about its strength and stability on the international stage. This trend raises important questions about the future role of the dollar as the world's dominant reserve currency and the potential impact on global markets and investors. Rick Rule points to 2 main factors driving this downward trajectory. First, the U.S. Federal Reserve has shifted from a restrictive monetary policy, characterized by aggressive rate hikes between 2022 and 24, to a more accommodative stance as inflation pressures began to ease in mid-2024. Second, geopolitical and trade uncertainties, particularly stemming from the administration's aggressive tariff policies and unpredictable foreign relations, have contributed to diminishing confidence in U.S. assets. Rule emphasizes that in such an environment, gold becomes a vital hedge. Historically, as the dollar weakens, gold tends to appreciate significantly, preserving purchasing power. He suggests that if the dollar continues on this path, gold prices could rise dramatically, potentially doubling, tripling, or more, underscoring its importance for safeguarding long-term wealth amid monetary and political instability.
There's a few things that are hated. Oil and gas is still hated. It's treated me beautifully for 5 decades. Some years good, some years bad, the last year bad. But it's a wonderful, wonderful, wonderful business. And these businesses, the public businesses, the better ones, are selling at half what they're worth. Will they recognize it in 2025 or 2026? I don't know. I don't have any idea. But I do know that if I buy them now and I hold them for 5 years, I'm going to have a really, really, really good 5 years. If you want a gamier suggestion, I really like the high quality rare earth space. Nobody understands it. Nobody cares. There are probably 50 pretenders in the rare earths, but there are, 2 or 3 speculations that while you could easily lose 30% of your money, you could also easily enjoy 20 baggers. And I sort of like that. I'm impressed with the moves that we've seen in the gold bull market. Gold bull markets follow a predictable pattern. The gold goes first, the best of the best goes next. We're in that third inning, if you will. You've seen the Francos, the Wheatons, the Agnicos double in 18 months. What happens after this is that momentum attracts people to the whole sector, and you have valuation arbitrages. The best of the rest gets cheap compared to the best of the best, and either value arbitrageurs like me move down the quality trail, or the best of the best take over the best of the rest. And then it proceeds on down the trail. This gold bull market is following an extremely predictable pattern. It's happened 3 times before. And there's opportunity for our attendees to understand where the gold market's going to go and stay ahead of the curve, which is very, very attractive. At some point in time, you and I have talked about this before, when generalist investor capital gets attracted to the precious metal space because of the momentum in gold, silver starts to move. Silver begins to outperform gold. I don't know when it's going to happen. And I think I told you this before. When it happens, you won't need Rick Rule to tell you it's happening. It'll be really, really, really dramatic. At some point in time, the high quality, small silver stocks, more likely than not, are going to rip. Absolutely rip. So we've had a reasonable collection of those here at the conference. And we've told people what to look for, how to buy them, and to be patient. When I look at the copper market and I look at the oil and gas market, the softness in energy prices, even as production plateaus, tells me that the economy on a global basis is weaker than we expect. Platinum and palladium are economically sensitive. So and I'm not an economist, as you know, I'm a pawnbroker. If the economy continues to deteriorate, likely that softness will extend to the internal combustion engine sales, car sales, and that could impact platinum and palladium prices. Looking longer term, platinum and palladium are likely still selling below the total cost of production, and there are still substantial supply risks. If you think about it, platinum and palladium come from 2 places, really, South Africa and Russia. Neither of those places politically are garden spots. Russia is at war, which is difficult. South Africa has ongoing social challenges that haven't yet really manifest themselves, but I suspect will. In the South African mining industry, first of all, the South African government keeps making noises about nationalizing the mine or increasing the social take. What that means is that the mining companies won't make substantial capital investments in the mines because they don't know who's going to own them. And that means that they substitute labor, cheap labor, for capital. They don't invest in capital equipment for the labor to operate. They don't invest in training. And that means that the laborers aren't getting paid enough money to live. The workers' wages have to go up, but the workers' wages can't go up. Because I don't know how that resolves itself, I don't have the courage to buy those. Perhaps the best expression of that would be the shares of Ivanhoe mines, which have been decimated because of their stability problems in Congo. They are bringing on a new mechanized mine in South Africa with 80 million ounces in reserves and resources. So perhaps the best way to express a preference in platinum and palladium, other than the Sprott product or Bravo, would be in the shares of Ivanhoe mines. My top ASX story is a rare earth story. It's meteoric. Lots could go wrong, and nobody should buy it until they get their financing done. They need to raise 30 or 40 million bucks. That needs to happen. Get that out of the way. What I like about meteoric is, first of all, rare earths aren't particularly attractive to Australian participants or anywhere else, so it's deeply out of favor. The asset's not an Australian asset, so Australian investors aren't focused on it. And it's an Australian domiciled company, so North American investors aren't focused on it, which is to say it's way off the radar screen. And as I told you, I love hate, if not boredom. So it meets that. It's a deposit with, I believe, at least $20 billion in situ reserves and resources, which is a tier 1 deposit. It would be, were it constructed, at least according to the pre-production studies, in the best quartile worldwide in terms of all-in sustaining costs and in the best quartile worldwide in terms of return on capital, which I love. It's in Brazil, which relative to the countries I invest in is ironically pretty stable. And it's in the good part of Brazil. It's in a part of Brazil that has roads, power, workers, water, all that kind of stuff. It will be at least a 5-year development time frame. So anybody who buys it has to be patient. Bottom line on this, I could easily lose half my money. Easily. And there's going to be lots of volatility, and it's going to go up and down and up and down. But it is a stock that I think, if things go right, could give me a 10-to-1 return or a 20-to-1 return or a 30-to-1 return. I love tier 1 deposits in out-of-favor commodity. I also like an ASX stock called Sovereign, which is a rutile and graphite developer in Malawi. Those are also commodities that are off the radar screen. Nobody cares about them. Again, ASX listed. Australians don't like it because it's not in Australia. North Americans don't like it because it's domiciled in Australia. Nobody cares about graphite. Very few people can spell rutile. And again, it's an enormous deposit. The third ASX junior I like is Centaurus, which is also in Brazil. And it's in the nickel business. And people hate nickel. They've gotten pounded in nickel. I believe it's the best undeveloped sulfide nickel deposit in the world. So those would be my 3 ASX. Deeply, deeply, deeply off the radar screen. There's an exhibitor here called Emerald Resources, which I've held for a very long time. I have a huge position in Emerald. Would I enter it in a big way today? Probably not. But I have huge built-in gains. These are people who built Regis Resources, which was one of the most successful Australian stories in the last decade. They're people I've known and done business with for 30 years. Buy and build strategy, superb guys. So that's something that people could take a look at if they're not as fond of hate as I am.
Looking ahead, silver appears positioned to recreate one of its most remarkable rallies in history, a rare opportunity that markets seldom provide twice. As physical supplies continue to tighten and investor demand steadily returns, the conditions are aligning to fuel a potential surge in silver prices. This is further reinforced by broader macroeconomic challenges, including inflationary pressures and geopolitical uncertainties, which together create a fertile environment for precious metals to thrive. The convergence of these factors suggests that silver could experience a significant upward trajectory, potentially rivaling past bull runs that delivered extraordinary gains. Simultaneously, ongoing currency debasement and evolving monetary policies by central banks around the world are steadily undermining confidence in traditional fiat currencies. As inflation persists and interest rates fluctuate, investors may increasingly turn to tangible assets like silver as a reliable store of value and a hedge against monetary instability. This anticipated rise in silver is likely driven less by short-term speculative fervor and more by a fundamental shift in how wealth is preserved in a rapidly changing financial landscape. Is silver's much-anticipated breakout finally beginning, and if it is, will it simply follow the pattern of previous rallies or surpass all historical records? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.